In my career as a financial journalist, I've experienced three bona fide investment bubbles. The first was the internet boom of the late 1990s, which peaked in March 2000 and then crashed. Shortly after that came the credit boom of the mid-2000s, which ended in the global financial crisis of 2008. And then, when I was living in Hong Kong, there was the Chinese stock market bubble of 2015, when investors in the People's Republic went on an epic share buying spree, mostly financed with borrowed money, pushing up the benchmark index by more than 100% in less than a year, only for everything to rapidly deflate. Now, we may be experiencing another bubble in artificial intelligence. The signs of exuberance are definitely everywhere, every day. Since OpenAI released its ChatGPT chatbot 3 years ago, the value of NVIDIA has risen tenfold, making the chip maker the world's largest company with a value of more than $4 trillion. OpenAI itself, a company that on its own forecasts expects to burn through $115 billion of cash by the end of 2029, and has signed deals to buy chips and build data centers worth more than $1 trillion, is valued by investors at $500 billion. Big tech firms, asset managers, and banks are pouring capital into data centers to run AI models and the applications that use them. The value of the S&P 500 index is now concentrated in just a handful of very large companies. Is this a bubble? That's the subject of a lively debate. Some people argue this is really an investment boom, driven mostly by large and very deep-pocketed tech companies which, bluntly, can afford to burn tens of billions of dollars on a speculative bet that might go wrong. Others, like the Amazon founder Jeff Bezos, maintain that this is a good bubble because the investment will benefit society even if some investors lose their shirts. Some even say there's a bubble in talk about bubbles. Deutsche Bank analysts point out that searches for bubble on Google peaked in August. So all this means that this week on The Big View, we're going to talk about investment bubbles. It's what we do at Reuters Breaking Views. We tap our best sources around the world for fresh insights into the biggest stories on business, finance, and economics. I'm your host, Peter Thal-Larsen. To talk about all of this, I've asked Edward Chancellor to come on the show. He's a financial historian, an investor, and a regular contributor to Breaking Views. He's studied many investment manias over the years, including in his book, Devil Take the Hindmost, A History of Financial Speculation. Edward Chancellor, welcome to The Big View.
Nice to see you again, Peter.
So, Eddie, the Alan Greenspan, the former Federal Reserve chair, at one point made this argument that said you can't tell whether you're in a financial bubble. The only way you can tell whether you've had a financial bubble is when it bursts and afterwards. You've sort of used the word bubble a few times in recent columns in the context of what's going on at the moment with AI. I just wonder, how would we know?
Well, should we just start with Alan Greenspan and his comments? Greenspan, who was then chairman of the Federal Reserve, in late '96, he made these comments about, how do we know when a market's inflated by irrational exuberance or not? And if you remember, he decided to just shelve the problem as too difficult. As far as I understand, Greenspan at the time had been advised by a couple of academics, Robert Shiller of Yale and John Campbell of Harvard. And Shiller, as you know, has become famous for presenting his cyclically adjusted price earnings ratio, which is a measure of the price earnings ratio for the market, but instead of based off the last year's earning, is based off the average of the 10-year real inflation-adjusted earnings. And the idea of that is you smooth out cycle. And so Shiller at the time was pointing out that the US stock market was getting into sort of bubbly territory. And what we see using the Shiller PE and Robert Shiller has data, which you can access on his website, going back I think sort of 1870 or 1880, is that there are these periods in which the stock market reaches a very high level against its long run average, and we saw that in 1929, and we saw that again in the late 1990s. So a very inflated price level of the market is one measure, and you can look at, there are other ways of measuring the price level. You take the market price to sale. Warren Buffett likes to look at sort of price to market capitalization. Now, is that a good, reliable, robust indicator? Sometimes it seems to work very well. It did actually in the 1990s. It did actually give you provide forewarning that the market was in a bubble, and by early 2000, the Shiller PE, cyclically adjusted PE, was the highest level ever, and was considerably higher than in 1929. And from that point, you did for the next 10 years, the US stock market delivered no returns for investors. They went down and they came up. But if you bought at the peak in March 2000, you didn't make any money for a decade. Now, my old boss at the investment firm GMO, they used some method similar to Robert Shiller to forecast long dated expected returns. And again, their model, which was based on the mean reversion of valuations of the PE ratio and of profit margins, again gave you a good indicator at that time. So valuation can be a useful measure. The trouble is, as you've probably already noticed, that if Schiller was pointing to an inflated stock market in late 96, the market had another 3.25 years to run.
Exactly.
So it's no indication, I'm afraid, of timing. It's just it's a red flag, if you will. And where we are, well, let's talk about later where we are today. Another measure, which is actually reasonably reliable and can be used in conjunction with the overall valuation of the market, is the speed with which the market has been rising. I mean, when people think of it, every bubble is a bit like a pyramid scheme or a Ponzi scheme. It's inflated by, as JP Morgan would say, more buyers than sellers. And as the buyers come in and rush in, imitating each other, fear of missing out or whatever, or momentum trading, it leads to rapid rise in prices. So that I think, and I studied this with an analyst of mine when I was working for Jeremy Grantham. What we found is that the sort of super exponential movements in stock prices, along with high valuations, were pretty useful measure. And incidentally, GMO would also run these long-term price series, real price series for assets, and they would, so to speak, call a bubble when the asset had moved 2 standard deviations from its long-term mean. Now, unfortunately, and that measure again works sometimes, doesn't work always. There is another thing to bear in mind. And this is actually some work I did for another investment firm called Marathon, in which looking at something that they called the capital cycle. And what is an important feature of most, if not all, bubbles, but really, I was going to say all great bubbles. It's not quite true of every great bubble, but most bubbles, is that there should be a huge amount of capital flowing into the bubble area. And we'll discuss probably later, the classics examples, the sort of railways in the 19th century and in Britain in the 1840s, where railway investment rose to, I think, about sort of 7% of GDP. In the late 1990s, there was a great surge of investment in fiber optic cables and telecoms in general, and in mobile telephony and so forth. And the important thing to bear in mind about this so-called capital cycle theory is uh, it says we do not know the future. We cannot get accurate predictions or forecasts about future demand, but we do have a reasonably accurate picture of ongoing capital expenditure. So the capital cycle, or a negative capital cycle, when a vast amount of capital is flowing in, is negative, is another good bubble indicator. I'll give you, I mean, there are myriad others, but amount of debt being used is also important. Not always evident, but if there's accumulation of leverage and complex financial arrangements, that can be an indication. If a lot of companies are coming to the market, a lot of IPOs, that can be an indication. If there are a large amount of retail interest, if the day traders suddenly rise from the dead, those are other indications. So there are, I would say that no single indicator can give you a clear bubble picture, but if you can see several of them together, that's an indication that a bubble has probably formed. Unfortunately, as I said before, it's not going to give you a huge amount of insight into timing. I did a study of 330 quantitative study of 330 bubbles. We found that the bubbles could go. They once they broke two standard deviations from the mean, there was no absolute limit to how far they could go. And with certain bubbles, in particular real estate, there was no absolute limit to how long they'd last. So there will always be uncertainty about how to trade a bubble. But I think for the conservative investor, we have reasonably good indicators to say, well, hang on a sec, now's the time to probably step back.
Things are getting a bit out of hand. That's really helpful. I mean, so look, just in a, I mean, that's a very comprehensive answer to that question, which is very interesting. Just sort of to try and sort of put it in a nutshell, if you look at what we're seeing today in terms of valuations, in terms of capital, in terms of, debt and other things, so where would you sort of, where would you say we're seeing the red flags now with
Well, I mean,
this AI
we're
craze?
obviously talking about AI.
Yeah.
And so let's talk, let's start with valuations. In OpenAI has a reported valuation of pre-market valuation of 500 billion. The aggregate, the leading AI related stocks now account for more than 30% of the total US market capitalization. On a Schiller PE basis, cyclically adjusted price earnings ratio, the stock market is at its highest level since 2000, and the second highest level of all time. I think I mean, again, not good timing, because I think I wrote about it last year, saying, or earlier this year, we're 3 standard deviations from the mean. So yeah, it's a highly inflated market. The market, since its recovery in late 2020, has been moving up pretty rapidly. So that ticks another box. Now we've got, on the capital investment side, I wrote about this view last year and then touched upon it more recently, is we've got huge amount of capex coming forward in the AI space to build out these data centers. So and there are, as you know, there are various estimates. So Morgan Stanley has an estimate of 3 trillion capex until 28 in the AI space. I think Bain has an estimate of 5 trillion by 2030. So there is definitely a huge amount of capex. It looks at sort of various comparisons I've read. It looks as if capex is running already somewhat above the level it reached in 99 2000 during the
Oh,
telecom,
really?
the technology, telecoms, and media bubble. Um, as for other things, you've got you've got an increasing amount of debt. Morgan Stanley, in their notes on AI, they estimate of their 3 trillion of putative capex, nearly a half is going to be debt funded, and then leaving aside actual debt, you've got all these leases that are
Yeah.
being and commitments that are being made between between Nvidia, the producer of the AI chips, the GPUs, and various users like OpenAI and CoreWeave, and then you've got deals with Oracle and so on. And these are all actually leasing commitments. These are commitments that are in effect like debt or off balance sheet.
Mm.
And currently, the companies themselves can't actually make those commitments. They're all posited on revenue growing very rapidly in future. So
Yeah,
I
there's
think
kind
that
of
was another
yeah.
red flag.
There's definitely sort of there's an element of sort of bootstrapping it, and also and Nvidia committing to invest $100 billion in OpenAI, and then OpenAI buying chips from Nvidia. Sort of there's a sort of circular aspect to it as well. I just want to come back to something you mentioned earlier, which was sort of this little bit this dilemma. Um, I think it operates on several levels, right? Which is essentially both for the companies and for the investors, a fear of missing out, or a fear of, or even worse than a fear of missing out, a fear of I have to do this because my competitors are doing it, and if I don't do it, I'll be left behind. I mean, it seems that's another sort of classic sort of bubble type, or something that can contribute to a bubble.
Oh, absolutely. And I think that why this is an important insight is it moves the analysis away from the pure the old-fashioned sort of extraordinary popular delusions of the madness of crowds. This is all, the idea that all bubbles are really to do with investor irrationality. In fact, there is an underlying rationality that can drive the bubble. Unfortunately, it's rationality that's built on a sort of fallacy of composition, namely that it may be rational for one person to engage in the bubble activity, but when everyone does it, you create a dangerous situation. So um, the way I wrote a piece for you mentioning what I say were a trio of dilemmas that appeared to be driving the AI boom. And first of all, there is this thing called the innovator's dilemma: is that if you're an incumbent in an industry and a new technology comes along, do you embrace it, even if there's a huge amount of capital spending going on and the prospects of potentially low returns from that investment, or do you stand back? And this is Bill Gates commented on this about AI a couple of years ago, which was when he said, "Look, the AI technology has the potential to erode the moats around these big tech businesses. Take for instance Amazon and its lock in on e-commerce. As you know, in recent days we have seen an announcement that Walmart is going to go onto the OpenAI platform. So it's conceivable, if you have agentic shopping, that Amazon's moat disappears. It's conceivable, once everyone has their own preferred AI chatbot, that the Google search business uh, disappears. So in all these areas, these companies have to invest defensively for fear that their competitive position is being eroded. So that's one problem, and the other problem, say, is a prisoner's dilemma problem, which has faced the builders of the data centers, the so-called hyperscalers face, which is if one business chooses to invest and the other business chooses not to invest, then the business that invests is likely to pick up the prize. So that actually creates, from a sort of game theoretical perspective, an incentive for both people to invest, at which point you are likely to get overinvestment. And that's the history of past bubbles, in which case everyone ends up worse off. So the prisoner's dilemma is another dilemma to think about. Now, think of the wretched investors. Not your sort of not your day traders, not your not those type. Think of the serious institutional investors with a so-called value bias. What are they to do? The AI stocks, the big AI stocks this year, and when I looked at it a week or so ago, they were up about 30%. The top 8 stocks, and the rest of the market was up 8%. So if you completely ignore the AI story, you risk 20 points underperformance or more from ignoring it. And now, what we saw in the 1990s is that the bubble was driven by what my boss Jeremy Grantham called career risk, and Jeremy actually experienced this in spades because he was running his firm GMO, and he wasn't taking the dot-com tech boom. He wasn't buying into it, nor were the funds that the firm was running, and the assets managed by the firm fell by half at a time when the stock market was actually increasing. So you would have expected a normal world for their assets to increase, but actually the clients ran out the door. I actually don't think
people were pulling money out.
Yeah, absolutely, and for fear of underperformance. I don't think that problem is quite as pronounced today, in part because the advance of passive investment and indexation has become so pronounced that if investors want to own the market and don't want any underperformance, they just buy the market, and then now tend to have niche funds. You can have a growth fund or a value fund or emerging, whatever. Now, speaking to investors I know, who so to speak, serious investors, they tend to they tend to retain AI exposure, not full-blooded AI exposure, but they tend to have a bit of incremental AI exposure for fear of too great underperformance. So they're under the same sort of pressure, the same type of dilemma as existed in the late 90s.
It's very interesting that, I mean, it's definitely, I have a few friends who are in a sort of similar position, and one of the sort of things about this is that we're in this market where the stocks are going up, and they're all incredibly miserable because, for precisely that reason, because basically, the decision they have to make every day is sort of, do I go, do I buy my full weighting of the US market and of a handful of companies, and particularly of Nvidia, and Nvidia is now, in stock market terms, is as big as the Japanese stock market or something like that. So that whatever decision you make with it, you can make lots of decisions, good decisions about Japanese stocks. It won't make the blindest bit of difference if you're underweight Nvidia. And so they're very stressed out about it, I think. And this presumably contributes to all of this, everybody sort of keeping it going.
As Howard Marks of Oaktree Capital said, if you're early, you're wrong. That's how it's seen among professional investors. I actually don't take that view. My view is that if you're managed, anyone can invest passively, fair enough. But if you're going to actively manage, you want to have a long-term horizon. And frankly, if you have a long-term horizon where some investments have low prospective returns, it's to be up 8% is not a bad thing. So really serious investors has to think about their absolute returns over a medium term period. Otherwise, frankly, they shouldn't be doing it. So at least that's what I tell my tell my friends who who are sort of wondering whether to sell their remaining AI stocks.
That's how you cheer them up. So so another aspect of this whole discussion is really about whether bubbles are bad or good. And so um there is this view, I think most recently expressed by Jeff Bezos, the founder of Amazon, that the bubbles can be good, and that you get this enthusiasm for a new technology and everybody rushes in to invest. And yes, maybe it doesn't work out for people, or for some people, but at the end of the day, you've made the investment in the technology, and the technology persists. And people use this very this argument very clearly in the context of, you mentioned the railway boom in 1840s Britain. Lots of people lost money building railways, but then Britain had lots of railways. Similarly with the telecom bubble of the late 1990s, they companies laid lots of fiber. They then went bust, but the fiber was still there and it was used productively for communications. So I just wonder how you sort of think about that argument in the context of what's happening now.
Well, I mean, first of all, I think that there's there's an element of truth in what Bezos says, and that and one can take it, one can take it a bit further. There's a plausible argument that the bubbles can accelerate the adoption of new technology, whether it's railways or internet or AI today, and that and these groundbreaking technologies are often associated with long-term improvements in productivity. Schumpeter's creative destruction. So that's a point worth making. Uh, but you don't want to take it too far, because there are these downsides to the bubble, and that's what I wrote about in Peace View. And what are the downsides? Well, first of all, there are the downsides for investors who buy into the top of the bubble. Now, if you bought into UK railway stocks in, I think the peak of the bubble was towards the end of 1845, over the next 5 years, you lost 85% of your capital. If you bought into the US stock market, the peak 1929, you lost nearly 90% of your capital. If you bought into the Nasdaq in March 2000, you lost 80% or nearly 80% of your capital. You bought Bezos's Amazon at the peak, you lost 94% of your capital. And so those are losses, and that's generally recognized. They say, oh, yes, bubbles are bad for investors, but good for society. I don't think that, I think, as I say, you can take that too far, in the sense that there is also a huge amount of capital misallocation. And when capital is misallocated, investments are made that don't generate a return, they are not socially optimal. I think I wrote for you last year about the railway bubble of the 1840s in Britain, where you had 3 railways between Leeds and Manchester, 3 railways between London and Peterborough. You had, you ended up, the British ended up with a pretty extensive railway network, but they could have got the economic benefits of that railway network with probably a third less money spent. So that's another point, the misallocation of capital. And then there is this other thing that the people, what do we call the sort of the ebullient bubble blowers ignore, is that actually most of the great bubbles have been followed by financial panics and severe financial crisis and economic downturn. So, I mean, I cited, in the recent piece, the canal mania in Britain in the which was in the 1780s into the early 1790s, followed by a banking crisis, the railway mania of the 1840s, followed by a financial crisis in Britain in 1847, another railway mania in the US in 1880, in the early 1880s, followed by the first Great Depression, the 1929 bust, followed by the real McCoy Great Depression, and a severe, well, an apparently mild downturn after the dot-com bubble, and that because the memory of the financial markets and the operatives stretches at maximum 25 years, the period in which Breaking Views has been in existence. That 25-year period, people focus on the dot-com bust, and they say, well, the aftermath of the dot-com bust was relatively mild. We had a mild recession. It turns out that the default rate after during the dot-com bust was actually a lower default rate during the recession of the early 1990s. You had a mild recession. So what's not to like? And I said, well, actually, what's not to like is that in order to stave off a more serious downturn after 2000, the Federal Reserve cut interest rates to 1%, which was then a post-war low, and that created the conditions from which the real estate and credit boom were to emerge. It created a surge of rising U.S. house prices, in other parts of the world. It created a search for yield that expressed itself through these subprime securitized mortgages, and that ended in the global financial crisis and the Lehman bankruptcy. So I say, if you're really going to properly consider the aftermath of the dot-com bubble, you have to take into account that the global financial crisis followed from the downturn, in which case you could say that its aftermath was actually the second most serious aftermath of any speculative boom, with the exception of the Great Depression.
No, that's a very good point. And I mean, and we don't need to get into this right now, but you could even argue it, was what happened from 2000 to 2007, 2008. That was a debt bubble, really, in many ways. So the bubbles come in different forms. So Eddie, this has been really fascinating. I suppose, I mean, just coming back to where we started on all of this, I mean, you made the point very clearly that timing these things as an investor is well nigh impossible. They can go on for longer than you think, and then they can stop very suddenly. But I suppose one thing to think about here is in terms of looking back at the history of bubbles, is what kind of catalysts tend to cause the bubble to end? Are there sort of things we can point to that actually bring the party to a halt?
It's often rising interest rates. I mean, it's a fairly boring reason, but if you think about it, rising interest rates raise the cost of capital. Given that a lot of these bubbles I mentioned carry a lot of debt, and a lot of that debt is very flaky debt, it's sort of Ponzi debt, then rising interest rates tend to kill it. We've got we had this current bubble is slightly anomalous in that it really got going after the Fed started raising interest rates in 2022. Financial conditions now, as you know, are pretty loose. Fed's been cutting. I understand that that the spreads on corporate debt are very low. These are indications that this debt is potentially vulnerable. So what I mean that I would say is the classic bubble indicate, bubble threat. But it can also just be an economic downturn, a recession. I would have thought that if the US were to enter into recession, given that the economy in the is really being driven by AI investment and the wealth effect from this AI boom, that a recession might change speculative psychology.
Okay. Well, we will observe with interest, and maybe come back in a few months' time and see whether the party's still going, or whether it's come to an end. But Eddie, this has been really really fascinating. So thanks very much.
Thanks, Peter.
That's all we have time for this week. Thanks to Edward for that great discussion, as always. And thanks to you for tuning in. This podcast was produced by Oliver Taslich in London. You can listen to a new episode of The Big View every Tuesday. Don't forget to tune into our sister show Viewsroom every Thursday, as well as the other great podcasts from the Reuters team. To get in touch with feedback, questions, and ideas, please email us on breakingviews-podcasts@tr.com. That's breakingviews-podcasts@tr.com. If you liked what you heard, please rate the show and leave us a review, and check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.